Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend and special guest, Dr. Friday with Dr. Friday's Tax and Financial Services. She is a tax expert for individuals and small business owners. You know, one of the things we've been talking about all morning are these tax law changes, and we've had some great calls, and we're going to take another one. This is Thomas. Let's see. Here we go. Thomas, welcome to the Retirement Report.
Yes, sir.
How are you today?
Oh, pretty good, I guess.
Excellent. How can we help this morning?
Yes, ma'am. Yes, sir. I have a question. I draw Social Security disability, and this starting in January, I had changed my Medicare Part D, my drug coverage,
Right.
and Social Security had taken out for my premium. Well, I switched insurance, and when I did that, I don't have no premiums coming out. So how do I go about getting that back?
Well, you don't have premiums being deducted for your Part D. Did you switch over to a Medicare Advantage plan?
Yes, sir. I switched over to Welfare Classic, and it don't have no premiums.
Okay. Well, you're not having to pay, but are you still receiving prescription coverage?
Yes, sir. Yes,
Yeah.
sir. I still receiving coverage, but they took out. They're going to be taking out.
Oh, you're looking to get a refund?
Yeah, that's what he's looking at.
Yeah, I had to go back getting the $36 back.
Well, you'd have to go back and if you would be able to get it, if you when you switch over to Medicare Advantage and you didn't have to pay it anymore, if you had prior to that, you would still have it available, or you still would have been required to pay it. But if you overpaid, yeah, just call the insurance company and file the necessary papers showing them, if they were deducting past the point they should have, they'll refund that. Okay. One of the things when it comes to Medicare, this is one of those areas that, I get these questions a lot. And the new tax laws, this goes to the provisional income form I'm going to talk about right now, which has to do with taxation of your Social Security benefits. The new tax laws aren't going to affect that. It doesn't look like anything that we've seen yet addresses any changes with regard to provisional income formula, which is too bad in some ways because the provisional income formula had set limits back in, for the 50% taxation, the caps on income there were set back in, the early 1990 range, at 1992,
Oh, really?
I think.
Okay.
This was when Bush Sr. was in the White House. I think the legislation was passed during Reagan's years at the very end of his term, and it went into effect then. And the same thing with, and then there was an 85% of your Social Security benefits. That piece was added in under Clinton's years. So guess what? Yeah, Republican and Democrat, doesn't matter. They're coming after your taxes, tax-wise, right? So that was added in Clinton's years. But the limits, think about that. So, in all these years, 20 and 30-year periods, they have not changed, or it's 30 plus years. So they haven't changed in terms of no adjustment for inflation. So more and more people find that their Social Security benefits are impacted with regard to taxation of those benefits. So we haven't seen anything to change that either. So it looks like that still has not been addressed. You'll still be paying tax most likely. For most people, you're going to pay some amount of your Social Security benefits are going to be taxed, whether that's up to 50% or up to 85%. Depends on what other income you have, and it doesn't.
Means tested, right? Is there some means testing involved in that
essence,
particular?
you've got it's about 20. Let's see, for a single person, I think it's 25,000 as an example. So if you add half of your Social Security, whatever you receive for an individual, and if you're taking any money out of an IRA, required minimum distributions as an example would count, then that can you add those together. If they exceed 25,000, and up to 50% of your Social Security benefits could be taxed. If it exceeds, I think it's either 32 or 34,000, up to 85% of your benefits could be taxed. And for couples, the numbers are a little higher. I think it's either, again, that 32, 34 number for the base, and then up to 44,000 or 44,000 or above for 85% of your benefits to be taxed. So if you're making 30,000 on your benefits, that means that you could see 25,000 of those as taxable income, depending on what other income sources you have. So one of the, and again, this has not been addressed in the new legislation, so we're looking at basically a lot more, more people again are going to be impacted because those numbers haven't changed in all these years. So the fact that our incomes are going up doesn't mean that they're making any allowance for that. When you get into planning, then the same thing goes with deductions. If you've got on your medical side, if you're Social Security, you've got Part B, you've got Part D, as caller Thomas there was talking about. If you've got a Medicare Advantage plan, this is a way that you can, potentially save. You need to understand how these things work. Right. We deal with that a lot in my office, helping people determine when to take Social Security, whether at 62, at 66, at 70. What's the best time for you? If for a couple, do one take at a different age than the other? Medicare, what kind of choices you need to make there, and which one's going to be in your best interest, trying to figure out the best one to minimize your costs and give you the best coverage possible. These are all things we get into, and that's where the comprehensive planning comes in. And I'm going to throw it out there again. If you're one of the first 10 callers to my office, all right, 615-376-5325, there's the number on your screen. One of the first 10 callers, Tess is standing by. She'll get your information. She'll send you out a checklist of things to bring to your appointment with me. And if you would like, we can have Dr. Friday join us for a great tax planning appointment as well. We get into that anyway. One of the things with comprehensive financial planning, when I'm talking about that on this retirement income analysis, I want you to see something that you can really use, whether it's 1 visit, 2 visits, 3 visits, no cost for this. I'm going to give you a plan, right? That you're going to be able to now see your financial future and make, based on the decisions you're making today, see what that looks like, and then show you ways that you can improve that. One of those being, of course, minimizing taxes. When you start taking money, you've been putting money in those retirement accounts all these years, and it's tax deferred, and you got tax, tax breaks on it up front. You didn't have to pay tax on that money, but guess what? When you take it out, yes, 100% taxable at your highest income tax rates, which are ordinary income tax rates, as opposed to capital gains rates, as an example. So one of the things, if you'd like to take advantage of this planning and see for yourself, what about your investments? Everything's going so great right now. The market's been going on this great tear. We're the second longest bull market in history. Everybody's making money, it seems like, right? But are you making as much relative to the market, to the risk you're taking? And do you even know what that risk is in your portfolio, so that the next downturn, do you know how much your portfolio is likely to drop relative to the market? We can show you that. We can share it with you, and we can show you ways that you can reduce it while still being able to participate fully in the market at the same time. So again, one of the first 10 callers, 615-376-5325. Tessa's standing by to get your information, send you out the checklist. And when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. Wow. Woohoo!
Whew.
Life is
it's
good.
It's like Christmas all over again.
It is. Merry Christmas. Okay. One of the things, speaking of Christmas, Christmas gift is this tax legislation.
Yeah, there's a lot of little things. As you get reading through it, employees, many people receive something as simple as maybe your employer has a vacation that they give to the employee of the year, or an award program, or gift cards at tax time. As an employer, you are no longer going to be able, and that comes in effective as of January of 2018, deduct that. Any benefits you're giving to your employees through cash, gift cards, vacations, meals, sporting events that they, as an incentive to get them to do a little better work, well, it's going to be out of the kindness of your heart. There will not be a deduction. Fringe benefits like meals. A lot of places say, well, go while you're out, why don't you get yourself some lunch? It cannot deduct it after, and that's actually going back to January 1st of 2017. They're not allowing meals for employees unless there is certain things that will fit into that. But basic fringe benefits are going to be gone for the benefit of the employer. So as the employee sitting there going, hey, every year we usually get to go to Cabo, or we get this, or we go to the Titans games, or he takes us all to the Super Bowl. You might find that may not be an incentive now, because any dues that they're paying for the golf clubs or the golf or country clubs and all that, none of that's going to be allowed either.
What, no pizza?
I'm just saying, it's going to be the kindness of your employer, and you may find they're not going to be as kind now that they can't write it off as an expense. Well,
the reduction in taxes, though, could provide some other things, as we're seeing with some of the large corporations and some of the things they're doing right now. It's going to be very interesting to see how this plays out even further. It is. But very encouraging also in some of the things that have come out just in the last couple of days. All right, we're going to have to take a quick break. Join us here. We'll be right back on the Retirement Report.
The time has come to enjoy your golden years, but have you saved enough?
I'm Hank Parrott. Don't just